Please welcome to the stage RPAG directors, Matt Giovinazzo and Kellen Foley.
Good morning, everybody. I'm Kellen. This is Matt. First of all, how about this killer video they got of me out here surfing yesterday, huh? Not bad. Thank you for believing that actually could be me. I do like surfing, but most of the time it's just a bunch of paddling around and wiping out. So surfing is hard. And one of the things you learn when you start surfing, for any of those that surf in the audience or have taken a surf lesson, you can't fight the ocean, right? You have to be in tune with the ocean and harness its power to your advantage. And today, what we want to talk about is how you can take that same mentality when it comes to the investment due diligence aspect of your practice. And by the end, we'll all be shredding the investment NAR together. How does that sound? Good? All right. So let me ask, are you fighting investments? Right? Too often it feels like we are. Whether it's going through a client's investment review and only highlighting the funds that are on watch list, right? Talking about the underperforming managers, terminating those managers, and then going through the time-consuming fund change process, right? There seems to be this negative connotation with like the day-to-day investment activities that we do with our clients. Instead, why don't we make investments work for us, right? Have that symbiotic relationship with investments that can actually enhance our daily activity. Right? Weave a powerful story that differentiates you from your competitors. How about leveraging RPAG's limitless investment resources to actually save you time when it comes to investments versus constantly fighting against the current, right? Vince did an amazing job yesterday talking about how the RPAG system can save you time in your practice. We're going to carry that theme through to today and speak specifically to how investments can, one, differentiate you, and again, save you time versus being that time drain that I feel like too often it has become.
All right, let's start with Investments 101. You look at this lineup, it's self-evident that we structure a lineup like this, right? It goes without saying. Target date funds, core lineup, you nod your head. Yes, of course, it's what we do. Sometimes when we kind of accept things as fact, it's okay, it's good to ask why, and is there a better way to not get blockbustered, right? Kind of a tried example, but Blockbuster's so focused on beating out Video Sun and those other in-person retail DVD rental stores, and they're kicking ass at that. And they're sourcing DVDs at the lowest cost, passing that cost savings along to customers, expanding their inventory. They're winning that battle, but ignoring the bigger threat and emerging technology of Netflix, right? So what we're going to address is kind of the blockbuster-ness of the traditional lineup. What you'll find is a lot of that comes back to the fact that what we addressed last year and coined the allocation crisis, 62% of assets still sit in the core lineup. That's a challenge because those investors experience, on average, 3.8% underperformance versus any professionally managed fund. So 4%, that's life-changing. That's percentage points, not basis points. And all you're probably thinking, I've got the answer. This is easy. Save me 26 minutes. It's re-enrollment, right? And yes, that does temporarily solve the issue. But target date fund growth has really flattened out. It's been in the mid to upper 30s the last 5 years. And what we're going to look at is another stat for you. Half of investors, when they get in target date funds, are out of them in 10 years. So all the re-enrollments in the world are not going to solve this problem. And we're going to look at what is kind of wrong with target date funds and how we can enhance this. So let's stay on the topic of target date funds for a second. There's a lot of, and we want to go back to ask those two questions. Is your process differentiating you, and is it saving you time? So there's a lot of different ways to select target date funds. A common one is to select based on expense and performance. Save you time? Yes, it's very easy. Differentiate? Not really. It's pretty easy. Someone brand new to the industry can look at lowest expense, highest, that's what you want, right? Low fees, high performance, yes. Very easy to do. What you'll also see is in the long run, that actually takes you more time. Because selecting based on those factors, what changes every quarter, every year? Those two factors, quite a bit. So you're either going to be constantly changing the TDF or constantly explaining why you're not. That's a discussion that takes time. Or else you're leaving the door open to a competitor saying, hey, you chose based on these factors. I found you something better. Why wouldn't you hire me, right? Alternative approach is suitability. It takes a little more time from the outset. Definitely better for differentiation. right? It's still not a core service, I would say, delivered across the market. The people in this room are doing it way more, and many of you have seen how this works, right? In the long run, this actually saves you time. When you select a TDF based on suitability, demographics change way less than expense and performance, right? So you're kind of setting the expectation from the outset as far as why you're choosing TDFs, and you're not going to have to constantly revisit it. So staying on the vein of TDFs, maybe going a level higher, keep in mind TDFs are one type of QDIA. So we have a term called QDIA shepherding. I can't promise that's going to be in your service plan, the actual name. You might see cold plunge and creatine, though, in there, as you should. But the idea behind QDIA shepherding is pretty simple. You're helping guide clients amongst the myriad of different types of QDIA. And yes, I said the myriad of different types of QDIA. The idea is don't just go here to single glide path TDFs, because in reality, there's all these other options today, right? And what you see is these all offer a varying kind of trade-off in qualities of cost, personalization, and engagement required. And nearly everything is more personalized than target date funds. And that offers you a tremendous amount of differentiation. And again, these factors aren't that cyclical, so you're going to save yourself time in the end. And you know what? It's actually fun and okay to take an extra 5 minutes, kind of flex your investment muscle. It's a productive conversation. So a quick personal aside, I'll try to make this somewhat relevant, but I moved about a month ago. I said I'd never moved to the burbs, love walking places, but you get married, you have a kid, that you end up in the burbs, guys. So a lot of DIY projects, some I'm not capable of doing. So I was gonna redo the garage floor. I'm looking for like the epoxy flooring, right? A company for that. So I submit a bunch of bids, or request bids. A bunch of companies come back with their price, a little blurb about them. One took a little bit of a unique approach and asked, hey, is epoxy flooring the right like flooring surface for you? Have you considered other options? So showed that they cared, number one, and showed really a comprehensive kind of depth of knowledge outside of what I was just asking. Right now, in the end, I hired this company partially because of that. They're also lower cost. But the fact they were asking that just set them apart and again, showed that they care. So the idea behind this is don't just go here because your clients have target date funds because you assume like that's what they want or that they know any better. They're not asking about anything else. They don't know. That's really our job. And again, it's a fun conversation. Just like I didn't know there were other options for the flooring. And in the end, it didn't change my decision, but it was something that brought me closer to that firm, right? Firm, I guess, garage floor laying company.
So as far as this QDIA shepherding process is concerned, right, it's really more just have that conversation with your client to have, be the differentiator. There are some tips and tricks that we've kind of found out as we go through this process that I think can be helpful. One of the things in terms of just deciding whether or not like a more personalized QDIA is a good fit for a client is to review the percentage of investors that are in the core fund lineup, right, doing it themselves DIY, versus the single target date fund holders. And then increasingly a lot of record keepers are also providing data on mixed investors. So those that allocate a portion of their balance to the target date funds and then a portion to the core lineup as well. So the way we think about it is this. If you have a plan like Plan A here that has a high percentage of assets in the core funds or in these mixed target date fund investors, that's where a personalized QDIA, I think, can make a lot of sense because clearly these participants are looking for personalization in some capacity, right? But as Matt mentioned, the DIY investors consistently underperform those that are in a professionally managed portfolio. So to the extent that we can get those do-it-yourself investors transition to a professional account, right, like a personalized target date fund, the more likely they'll be better off, right, in terms of their performance and their behavior. Now on the flip side of that, right, Plan B here, if you have a plan that's mostly single target date fund users, right, they're using those target date funds appropriately, maybe that's where a personalized target date fund doesn't add quite as much value, right? But at the end of the day, it is kind of a subjective conversation. These are just some tips and tricks that we've learned along the way. Another one, in terms of deciding what type of personalized QDIA makes sense, because there's various options, is to look at the sophistication level of your client. So Plan A here, if you have a plan full of a bunch of Jeff Elvanders, right, they're very sophisticated. That's where we think something like a managed account or even a dual QDIA type concept can be a great fit, right? Where the target date fund automatically transitions into a managed account at a certain age. These solutions tend to be a little bit more complex, right? To take full advantage of a managed account, it's helpful for participants to add in outside assets, spousal assets, right? Other sources of income. So they typically have a higher fee associated with them, right? So you want to make sure participants understand the complexities that come along with some of those solutions. On the other hand, if you have an unsophisticated participant base, yes, that is a picture of Alex Kahn about to get hit in the face with a Jenga tower. I'm sorry, Alex, I had to bring this picture back. I love you, man. But if you have a less sophisticated participant base, right, that's where we think a risk-based target date fund can be a really good fit. And the reason for that is, right, it's a little bit simpler, it's more intuitive, it's lower cost. So it still allows these participants to get the personalization that they're looking for, right, but in a little bit of a simpler mousetrap.
So a lot of types of QDIAs, we've discussed everything is pretty much more personalized than a traditional target date fund. So we want to ask, what problems is that solving? Again, how is it differentiating you? How is it saving you time, right? The first thing is it's solving that allocation crisis. So that 4% underperformance the do-it-yourself investors experience. And you may be thinking, guys, you've had too many beers. How is the QDIA going to solve the problem for the do-it-yourself investors? And Kellen alluded to this. The idea is that it's attracting those investors to that professionally managed portfolio. How and why, and this is backed by plenty of surveys. You can kind of approach this anecdotally. When asked, those investors in the core lineup say, why'd you move out of the TDF? I just felt like I wanted to do something. No good reason, but I needed to do something. I wanted to decrease my risk tolerance. I wanted to increase my risk tolerance, right? So that's exactly what a personalized QDIA allows them to do, is do something, personalize, customize, right? And then experience that professional management and get 4% better returns, right? The target date funds, then, those investors are more likely to stay the course, right? So we're increasing the overall TDF utilization. And what we're going to look at in a bit is how a more intuitive and kind of educational experience with the fund itself can improve the results, and not just the results, but actually the experience of the TDF investors. The second thing that a personalized QDIA can do is it can save you time with plan sponsors. So you all have seen the DOL tips on target date funds. Some of the points here are very obvious. Third one down, review fees. They mention performance. As we've said before, they mention this concept of glide path risk and aligning that risk or glide path with participant characteristics 8 different times. So that's our fit analysis, right? That's a huge emphasis of the DOL. So Kellen, I have a question for you. What do you think is quicker? Gathering data for a fit analysis, interpreting it, filling out a questionnaire, building the report, prepping, and presenting it, or filling out a FlexPath CIT agreement?
CIT agreement.
You're correct. Good job. So look, the idea behind FlexPath and risk-based glide paths is, of course, participant-level suitability. It's personalization. Take that a level higher. What do you get? You get guaranteed plan-level suitability, right? Really foregoing the need to run a fit analysis for every one of your clients and revisit that as demographics change.
Another way a personalized QDIA can save you time with plan sponsors is by shifting your focus away from what I'll say are traditional, I did traditional instead of boring, performance metrics here, right? Where you're just basically listing a bunch of numbers, right? Yes, this is what plan sponsors are asking you for, but again, just because they're asking you for it doesn't mean they know why. This doesn't allow you to tell a story with performance. In fact, what it probably ends up leading to is defending performance for the target date fund when the glide path you've chosen doesn't align with the market environment that's currently taking place over whatever time period you're looking at, and then probably chasing performance, right, and repeating that cycle over and over again. Instead, what a personalized QDIA can do is allow you to tell a story about how the target date fund or whatever QDIA you choose actually meets the objectives for the people at the end of the day, right? We have to remember people are investing in these target date funds. So instead of just looking at absolute performance, tell a story about how these solutions can actually meet the individual objectives of the people that are invested in these solutions. So this is one of our favorite examples of this, where we look at a risk-based target date fund and how it can achieve the competing objectives of aggressive investors, right, while at the same time also achieving the objectives for conservative investors, right? To contrast that with the absolute performance aspect, right, the target date funds that perform best right now may be a great fit for aggressive investors, but they're probably not a good fit for the conservative investors, right? So this really allows you to achieve outcomes for a broader range of participants in the plan, right? Frame performance in a different way, which also leads to fewer fumbles, right, from your perspective as well, because again, you're not defending performance. You're gonna have a solution that looks good really in all market environments, right? So you're not chasing performance. It also helps with client retention, because as Matt mentioned, when you change the conversation, you're not leaving yourself susceptible to a competitor coming in and just bringing a better performing or lower cost target date fund, which inevitably is always going to be the case. By the way, this is a preview of what my Jets are going to do to Josh Allen tonight.
All right, let's look at, they may do a bit of stumbling like this as well, Kellen, you never know. Let's look at participants for a sec, how you can save yourself time there, hopefully without a face full of track. Most of you do wealth management to some capacity. For those of you who don't, you're doing employee education. Lord knows we all get calls from participants. What do I do with my money? And look, it's natural to feel differently when you get calls from these two different groups. Compliance likes stacks of ones better for like representing the $1 million balance. Don't know why, and I won't go there. But nevertheless, look, it's a better revenue opportunity. It's more exciting. We have more ways of being creative and helping the larger account balances. But part of why we all do what we do is the altruistic side. You want to devote a lot of time to the smaller balance, people asking for help, but it just doesn't make sense for our ongoing service model. It's not sustainable. So historically, for those individuals, our options were really, number one, kick them to a TDF, right? Not great for differentiation, retention, service, but it's very time efficient. Or you spend a half hour on the phone with them, walking them through the principles of diversification. That is great service, you're helping that individual, but it's not sustainable. It takes a lot of your time, right? This is where our Discover Your Path tool and the revamped FlexPath website, many of you have seen this, that we revamped the end of last year, can really pay dividends for you. So this is now a complete holistic education portal for participants. It does kind of center around this Discover Your Path tool, 4 simple questions that participants is guided to their best fit glide path. They can model like how changing their savings rate impacts things, how the portfolio changes over time. There's educational videos, fact sheets. It really is a complete portal now. So now picture, you get that call. You don't necessarily want to devote an hour to that conversation. You send them a website link, and very efficient, saves you time. And now it's a great differentiator, and it's a high touch level of service. It's personalized, constructive, hands-on guidance for that individual. Now look, I would love if everyone went to that site. Realistically, you can get 10, 25% of people doing that, engaging with the tool, and that's a great number. It's a lot of people you're helping. Realistically, even more people just change their glide path based on the name of the fund. Kellen alluded to this earlier, a transparent naming convention. A lot of people just choose based on that. I see aggressive, okay, I know it to experience, right? So now maybe we're up to like a third, half of participants. So for the other half to 2/3, if my math is right, they're just, if they don't do anything, it's okay. They're just in the normal TDF, right? And at some point, it could be a month from now, it could be a year from now, it could be 10 years from now, they're gonna look at the name of the fund. They're gonna see it somewhere, and they're gonna know how that fund is invested. They're gonna see, okay, it's aggressive 2025, and there's a lot of value to that. I'm pulling up a quote, but I get a text from my wife. Hot water smells musty. So that's the next project. But if this guy says, are you sure you don't want musty water? I'm gonna not hire that guy. I do not want musty water. All right. Understanding what is reasonable to expect can improve one's ability to have patience when investments are not performing well. An investor must have a firm grasp of their current path and why it will help them reach their goals. Kellen Foley quantified, no, I'm kidding. This is a legit study. Kinnery et al. In 2019 quantified the value of behavioral coaching as 1.5% in net returns. So again, 1.5%, these are percentage points, not basis points. The only way you can really accomplish this for a traditional TDF is a massive education campaign that's not going to save you time.
So all that sounds great in theory, right? So let's actually look at a case study of how this can play out in real life. So this is a plan that we looked at. We'll call it Plan A. We looked at the assets invested in target date funds and then in cash at the end of 2021. So 14.9 million in target date funds, 2.7 million in cash. Fast forward to the end of Q1 of 2023. So right after the market turmoil, obviously, that we experienced in 2022, how did participants react in that market environment, right? So what do we see? Well, we see a 10% decrease in target date fund assets as a percentage of total plan assets, and a 37% increase in cash assets, right? And this is what we saw really industry-wide. Target date funds saw the most outflows of any asset class last year, and cash saw the most inflows, and it wasn't even close. 90% of flows went to cash. So this panic selling, right, occurs time and time again. We saw it last year. We saw it during the COVID drawdown. We saw it during the financial crisis. Target date fund investors are unengaged, quote unquote, right, until all of a sudden in the worst possible moment, they become engaged investors and they do the worst possible thing and torpedo their personal performance. So contrast that right now with Plan B. Plan B has a personalized QDIA, right? In this case, a risk-based target date fund. So again, same time period at the end of 2021, 14.8 million in the moderate glide path, 3.5 in conservative, 3.2 in aggressive, and then 1.6 in cash. Again, fast forward, end of Q1 2023, how did participants react? In this case, we actually see a 5% increase in target date fund assets. We do see an increase in cash, a 6% increase in cash. So you do see some of that flight to safety, but much less so, obviously, than we saw before. Where you do see the movement is the 21% increase in conservative glide path assets. Again, not ideal, right? You still have the panic selling going on, and in this case, it was coming from the moderate glide path into the conservative glide path. But that's a much better safe haven, in our opinion, right, than going all the way to cash. Because at least you're still invested in a target date fund according to your age, you have market exposure, so you participate in the recovery. And then maybe most surprisingly, when you look at the aggressive glide path, assets there actually ticked up a little bit as well, right? So investors that had previously elected into the aggressive glide path did not have the same sort of panic selling that we see from other investors, presumably because they are aggressive investors, right? They picked that glide path on purpose. They're comfortable with that sort of volatility. I also wanted to loop back to a point that Matt made earlier regarding target date fund suitability, right? So yes, it can save you time on a plan-by-plan basis. This is exponentially increased when you think about pooled plan arrangements, right? I've been working a lot with advisors that are starting their own PEPs or even in these turnkey type solutions where you're a 338, multiple plans are using the same investment menu. Not only can it be extremely time intensive to run a fit analysis for every single adopting employer going into one of these arrangements, it's also practically impossible that every single one of those demographics is going to be a good fit for the same glide path, right? So you can really just sidestep this entire suitability issue altogether by using a personalized QDIA and just acknowledging the diversity with all these different plans coming together.
All right, we spent a lot of time on the QDIA, certainly the most important part of lineups, but we want to focus on the core lineup and driving efficiency there as well. Most of you are familiar with our efficient menu design concept, the idea to provide mean and lean, kind of consolidated, streamlined lineups for participants, right? This 8 a.m. session, my voice, I swear. So look, what you're doing here, limiting the total number of options, is reducing the number of funds you're overseeing per plan across your entire book, saving you time. And obviously, it's streamlining, simplifying the investment election process for those individuals, right? The challenge with the core lineup is it's a decision, yes, no, with each fund. Am I investing in that fund? And then there's 100 possibilities, 1 to 100%. And that's where this goes awry, right? people don't know, I wouldn't know how to allocate between government, bond, and EM debt and high yield, right? Let the core plus manager do that, right? You're going to get better results. And it's important to delineate that versus choosing between 3 conveniently, intuitively named prepackaged options, right? That is easier, putting 100% of your money there, and honestly, no matter which glide path they choose, they're gonna get better results than navigating this mess. Leverage our investment team, our CFA charter holders, our 13 different investment staff that's working in the world of investments every day. We work for you. That's the RPAG pufferfish, right? We work for your clients. So leverage that to save you time and as a differentiator, that RPAG pufferfish effect. So what that team does is go through a robust search process. This is kind of a search funnel, if you will, and the goal is for our team to identify the best managers in each asset class. Of course, that starts with the scorecard. We're all looking at the same thing when we're choosing funds, right? Enhanced with some other quantitative factors, some qualitative factors like a portfolio manager interview. In the end, we get to the funds that we have the highest conviction in. That's our focus list. I'm sure it's somewhat similar to what you all are going through, right? So leverage that again, that focus list to save you time. And this visual alone can be a great differentiator, show a very robust process for your clients and prospects.
All right, and then we take that crucial final step, which is a massive differentiator, which is we actually negotiate with those focus list managers to get access to an exclusive share class, right, just for RPAG advisors. And this, to me, the RPAG CITs is the easiest example of how to make investments work for you. Clearly, it's a differentiator, right? Because you only have access to this, whereas your competitors do not. And then it can save you so much time. Matt just talked about the search funnel process that we go through. You all go through that process as well, but you don't have to, quite frankly, right? You can leverage RPAG's team to do 90+% of the legwork, and then you get to do the final step in terms of picking which of these managers you feel the most comfortable with. And then ongoing, our team meets with the portfolio managers on a quarterly basis. We write up commentaries to give you the insight into short, long-term performance, changes in score that are occurring. So this makes the ongoing due diligence process much more efficient for you as well, hopefully, right? Giving you the documentation that you need for meeting minutes, the sound bites you can use in client reviews. That ongoing due diligence process is very turnkey. And then while we never hope or obviously want to make changes to the underlying CIT managers, in egregious circumstances, we can change the sub-advisor. What this does, of course, is allow you to avoid the very, very time-consuming fund change process for all your clients that are using that strategy, right? It's all happening underneath the hood. You get to sit back and just communicate to your client what's going on.
All right, so in conclusion, don't fight investments. Get that symbiotic, that clownfish anemone relationship going with the goal. Make that lineup work for you. Allow it to let you be differentiated and to drive efficiency and save time. I'll leave you with, don't be afraid to challenge the status quo in life with plan lineups and ask the things that we accept as fact. Is that actually the best way of doing things? Is it likely to persist? And are we going to be doing it the same way in 10 years? And what do I know? Let's let someone else do some talking here.
In most companies, if you're new and you ask, why is it done this way? The answer is because that's the way we do it here, or because that's the way it's always been done. And in my opinion, the largest contribution of much of this quality thinking is to approach these ways of doing things, these processes, scientifically, where there is a theory behind why we do them. There is a description of what we do, and most importantly, there is an opportunity to always question what we do. And this is a radically different approach to business processes than the traditional one, because it's always done this way. And that single shift is everything, in my opinion.
Thank you all so much.
Thank you.